Bank of Canada holds interest rate at 5%. What's this going to do to the real estate market? I'm going to be breaking that down on this week's episode of Prime Properties TO. And I'm also going to be giving us a lot of information about all the macro things that have happened in the last, call it like week and a half since the long weekend. So this is going to be a jam-packed video, so make sure to stay tuned to the end. Now, if you are looking for some help on how to navigate this real estate market in the coming fall market, or actually it is fall market already right now, then you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prop, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the greater Toronto area on top of making awesome educational real estate content just like this one for you. And if you're enjoying a lot of the content, make sure we spread the knowledge by smashing the like button and subscribing to the Prime Props channel. So one of many articles we're reviewing today is Bank of Canada holds key interest rate at 5%, right? So we did say that the chance of them having a hike was 40%. And I think because the inflation numbers, the GDP numbers came in lower, this was all the more reason for them to actually hold, right? Despite that, there's talks about the US actually increasing. So one of the messages that I kind of highlighted from kind of the release was, while consumption has slowed and excess demand has eased inflation, the primary target of interest rate policy is still too high and sticky for comfort. So the rates are still too high, but if we kind of read between the lines of what these guys are trying to do, right? They're trying to rein inflation down. And I've talked in many videos before, just from like math and base effect, I don't see inflation coming down to 2%. Maybe we'll end at 3 to maybe 4%. So for us to actually bring inflation down to the 2 to 3% target range, we're actually probably have to start seeing maybe potentially more rate hikes. And that's kind of why everyone thinks that there's going to be one more baked into the end of the year. So call it the next one in October. I think it's the 12th, and there's another one in December. So there's only two more now announcements left for the rest of the year. Right now, they have it as like a 100% chance of one happening in October or December, but really it's going to come down to what the numbers look like, right? Because if you look at it from this perspective, the economy is slowing down right now. And I think from reading a lot of this stuff and how these guys are talking, they rather take a recession because we are, having a negative growth, and I'll talk about it a little bit later. They rather take the recession than have inflation go a little bit out of hand, right? Because they can't control inflation as well as they can kind of like cut interest rates during a recession to kind of spur economic activity, right? They don't have a good grasp of inflation. So I think the Bank of Canada is more afraid of inflation. Like I was saying earlier, just from math, I don't see it coming down to 2% anytime soon, right? So that's kind of what I'm watching right now. Now, on to kind of the GDP component, the Q2, so this would be April, May, June, right? These are quite delayed, so we'll get Q3 shortly. But you can basically see here that the GDP contracted by 0.2%, right? So the Bank of Canada actually thought that it was going to increase by 1.5%, and now it's negative 0.2. So that means it's about 1.7% swing, or like almost 2%. So that's a really wild swing. So you got to think about this. Bank of Canada, who has a wealth of knowledge of everything that's going on, they couldn't even predict where the GDP is going to be. So are we going to be in a technical recession come Q3? There's a very high chance. I do not see all the reasons that we have a negative GDP print being economically better in Q3. Like we're in Q3 right now, so that'd be July, August, September. And I can tell you, if the real estate market is a big component of the Canadian economy, July and August numbers absolutely sucked. Like not price-wise, but like transaction-wise, because transaction means income for everybody in the real estate kind of like business, right? You call it your realtors, mortgage brokers, insurance brokers, furniture, everything, right? So transaction volume is low, so I cannot see the real estate component on that being very, very great. On top of that, permits are very low, construction is also slowed down. So I would not be surprised by the call, I think when it printed like November, would be in a technical recession, 2 quarters of negative GDP growth. What's that going to do for kind of like the sentiment, and are there reasons to be hiking or like cutting? TBD, because we got to look at the job reports, because again, they're still trying to rein in inflation right now. Now, there's some really wacky kind of macro things that we got to talk about. So end of August, a bunch of like the Prime Minister's office got together in I think PEI or something to talk about the housing crisis, right? And Benjamin Tao, who's a pretty respected economist, basically came out and just made them look kind of foolish. He's basically said that, hey, guys, you miscounted the amount of permanent residents we have, right? So he's saying that, but his analysis were closer to 2 million people. And the main reason why we have 2 million people growth since 2021 is that there was discrepancy in them not counting people when their visa expired. So they just assumed that people went back to where they're coming from instead of staying here. So in his analysis, he thinks we actually have another million people that's in Canada right now. Yeah. Like, we're not talking like 1 + 1 is equal to 3. We're talking about like Stats Can forgot to carry a 1 in a 7-figure number. So it's not a small amount, right? So I mean, it explains why some of these rental numbers have been absolutely crazy, right? So they're saying that it's in their software, and I think they released some press noticing that it is going to change. But it's kind of really, really messed up how numbers are if it is miscounted by million. So this is a chart showing you basically how the population has kind of gone through. And you can see basically in 2021, since the pandemic, it kind of spiked up, right? This includes your NPR, so non-permanent residents, a lot of temp workers and everybody, and refugees as well, right? So from like Ukraine. Now, if I were to map the extra million people on this chart, and again, this is not super accurate, okay? But I'm just showing it for the purpose of how off the charts this is, like literally off the charts. So I had to make this photo bigger. Just looking at this axis, for us to get to 2 million, like 2.2, it has to be up here. This is how much population has grown. It's just silly. It is silly if they miscount it. And to kind of make things worse, so GDP per capita is going to get worse and worse. So this is kind of like like how good of a life one person has in Canada. And the amount of GDP per person is getting lower and lower because we have too many people, right? So it's always kind of been negative for quite some time since I believe it was 2021. And you can see there are a couple periods where the GDP per cap has gone down. So if they kind of revise these numbers, this bar line over here is actually going to go lower, and it's going to be very comparable to the 2010s, so 2008, and then the crash in 1990s, and then the recession also 80s, right? So it looks like we're setting up for some kind of recession, as I've been talking about before, and the GDP per capita numbers look absolutely bad. But if you only look at just like the real GDP number, it's going to go up because we have so much more people coming for consumption, right? And I think you need to understand some math and some reasoning for that, because the GDP is going to look like it's going to be getting better and better and growing. And that's why we're letting so many people in. But the fact that we miscounted a million people, right, and the GDP is contracting in Q2 tells us we're probably in some kind of problem where even extra immigration coming in can't paper over how bad our GDP is right now. So again, there's a lot of like stormy clouds looming in the back end that aren't looking too great, but the fact that immigration is at an all-time high, even higher than normal, and we're not building, sets us up for like a 3 to 5 year problem where we're going to have a housing shortage, which means prices are going to go up. But in the meantime, the short-term time, we got to get over this kind of recession period and kind of survive this, because there are some like short-term storm clouds, like I was saying. Now, the crazy thing is, I don't know the exact timing on this, but like whether it's before or after the housing kind of get together in PEI. So on the 27th, they basically said that, hey, this new person in charge of immigration is going to be like, you know what? We're just going to bring in 900,000 people this year instead, right? We're just going to increase it from last year. So you could tell all forms of government are trying to bring in immigration, which again, we've talked about before, makes total sense because it's trying to make GDP grow. But GDP per capita is getting worse. So the lifestyle in Canada is going to get worse because you have too many people coming in. You got to keep it in mind, when you have so many people coming in looking for jobs, it pushes down wages, right? And the housing keeps going up. So that wealth gap is going to get bigger and bigger. And when you go this into like a 3 to 5 year period where we're not building anything, way too many people, we're going to have another rip on real estate prices, right? And that's kind of like the long-term trend that I see right now. But again, lots of stormy clouds in the short-term future. You got to survive it, right? And then the last thing we got to watch out for in terms of like a lot of big macro factors is the bank earnings came out. And the main key thing I want to point to is that every single bank, made a little less money than what they thought, except for one, right? But a lot of the times we got to look for the loan loss provisions, right? So this is basically banks saying, hey, we got to set some money aside for a lot of these loans defaulting, right? So the big headline was CIBC, where they had to triple, not double, triple. So they originally had $243 million of like money set aside in case, I call it the mortgages default, right? Now they have 736. So most of the banks either doubled or tripled their loan loss provisions. And what that basically means is that they can't lend that money out. They got to keep it on reserve, which means that the revenue is going to go down. So they're going to find different ways to increase revenue. So I don't really see that, even though the 5-year bond market has come down a little bit in the last week, I don't see those kind of fixed rate mortgages discount being passed on to us as homeowners or investors, because again, if they drop it, they lose some revenue. I really think that they're probably going to keep the rates a little bit higher so they can make some more revenue. And, they're preparing for the worst, right? So there's some delinquency that's potentially happening. It's going to happen. It's just at what magnitude and how many of them are there going to be? And that's kind of why everyone's watching this. Now, right now, the fall market's about to start. And if things are great, it could paper over some of these problems. And then maybe that technical recession will be easy to get out of. But if the market is really bad in the fall, then, we're looking at like more stormy clouds coming up that will lead us into a bad spring in 2024. Anyways, I hope this gives you an idea of kind of like the short-term stormy clouds I'm seeing, but the long-term problems of housing affordability and kind of like where prices will be. It's like a weird mishmash of things. Like if you're going to do well as a homeowner and investor, you just got to have a long-term horizon, like what I've been saying all the time. But if you had short-term horizon and you're kind of hurting a little bit, you need to kind of like, again, cut off a little bit of cancer and survive to fight another day so that you don't kind of bleed to death on kind of like your carry costs for these high interest rate environments, right? Anyways, if you are looking for some help on how to navigate this real estate market, or you're concerned about your portfolio, or just kind of want to chat about real estate going into this fall market, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?